Welcome out to BluSky's Trading Lab here every Thursday, ladies and gentlemen. The last couple weeks, what we've been focusing on in this lab is we've been focusing on indicators. We talked about moving averages. We've talked about stochastics. We've talked about MACD. We've talked about RSI. Now we're going to kind of conclude our indicator conversation. And if there's other indicators you guys want to learn about, I am more than happy to prepare a lesson for you guys to kind of focus on as well. But next week, I'm going to shift topics a little bit, guys, from our indicator conversation, and we're going to start working on a little bit of alternative asset classes. And what I want to do next week is I want to start with the basic trading lab on identifying how to trade options, call options, put options, the basics. What are they? How do we trade them? What are the option Greeks? Then after that, we're going to get into a little bit of more detail. We'll do some zero DTE as we get down the road a little bit. That's something Riz and I and many others talk about in that power hour quite a bit. So get excited for those options conversations. But as of today, guys, what I want to really kind of focus on here today is I want to focus on Bollinger Bands and kind of how are they built? How do we use them? How do I identify them as overbought and oversold signals? How do we use the upper band and the lower band and the 20-period SMA in the middle? How to understand what a squeeze is, trend reversals and revisions and all of those jazz. Now, I like to kind of get a lay of the land. So I'm gonna ask you guys a question, and I want you to answer it like this. If you have zero understanding on how to utilize Bollinger Bands, put 0. I have 0 understanding. And if you have 100%, put a 10. RQ new, Cindy new. Link, you're kind of like F, you're kind of in the middle. Laura in the middle. Gab kind of new. Okay. So indicators in all forms. Okay, in all forms, whether you're talking any indicator we've talked about in this lab, indicators are secondary confirmation tools. But what they can really do is help you understand those price movements. You can really help you understand, should you be pushing it in a momentum condition? Should you be patient and wait on development? You hear me talk about this all the time as we're just kind of having conversations in the power hour. Oh, a secondary pattern needs to play there. Oh, we're waiting on pattern development. Some of that is based on price. Some of that is based on indicators. Some of that is putting it all together. But trading is always about kind of those basic trends, basic patterns within trends. And then we use indicators to help us understand the context of the trend and to help us understand if they are giving us divergence, like we talked about last week and the week before. Not a whole lot of divergence, I would say, in Bollinger Bands, or are they giving us that secondary confirmation? So what are Bollinger Bands, guys? Bollinger Bands are a couple different things. Number one, they were created by a guy by the name of John Bollinger. John Bollinger lives about a block away from one of my options mentors down in LA, actually. I've had a chance to meet John Bollinger, and wonderful human being who wrote a great understanding of what Bollinger Bands are. He told me one time, through my mentor, he said, Bollinger Bands are widely misused. And would you agree with that in general, that most traders widely misuse things that were developed by other traders in the past? Would you agree with that? Yeah, and I don't think that's unique to Bollinger Bands. And not at all, I don't think that's unique to Bollinger Bands. I think that is very, very common when you take into account any indicator out there. There's a specific purpose for it, right? Like for example, stochastics is an oscillating indicator that oscillates between 0 and 100. Talked about that last week. And the whole thing about stochastics is, all right, help me understand the totality of the range of the move. And what the author of stochastics said is, I'm willing to give up 20% of the low point, and I'm willing to give up 20% of the top point, and I just want to capture the 60% in the middle. I just want to capture 60% of the totality of the move. That's what stochastics basically in a nutshell does. is you try to capture the meat in the middle of that sandwich. You try to capture not the very low, not the very high. You're not trying to buy the low and sell the high. You're trying to capture that 60% of that totality of the movement. Every indicator has that, and I'm willing to bet every author of every indicator would come across with the same type of mentality that most indicators are widely misused. And that's what I want to talk about Bollinger Bands today. How can we use them? How can we include them in our trading systems? And how can you help use them to help you spot, squeezes and trends and overextensions and everything else? Now, I'll also say this, guys. The number one goal as traders is not to master the indicator. The number one goal of trading is to master the price action. Every decision we make is based on price action. Every decision we make on the trend, pattern, support, resistance, entry, stop loss, targeting is always based on price action. But it's those indicators that give us that secondary confirmation. Goal number one, master price. Goal number two, learn how these indicators can help you confirm if you're mastering a price is actually accurate or not. Now, in all indicators, it's important to understand how things are calculated. And when you're talking about the calculation of MACD, RSI, all those other indicators we've talked about, there's going to be some uniqueness to it. For example, I love the 9 EMA. I anchor against the 9 EMA on almost every single time frame, but specifically it's the holy grail of momentum for me on the daily chart. That is the 9 EMA. But a lot of traders will say, no, it's the 8 EMA, Matt, or it's the 10 EMA. And I'm like, I don't care. Whatever you use there is perfectly fine. They're going to give you a very similar read. Stochastics can be fast stochastics, slow stochastics. You can change the calculation to kind of adjust to your personal trading style. Same thing with almost every other indicator out there. Not necessarily Bollinger Bands, pretty standard. 3 settings on Bollinger Bands. You have the upper band, you have the lower band, and then you have what's called the mid band. And the mid band is really simple to understand, guys. In fact, I will show you exactly what the mid band is. Now, if we come to the indicators here, you see this indicator right here, the 20 SMA, okay? You see this blue line right here? That blue line kind of in the mid band. That mid band, if I add on top of that the 20 period moving average, you will not be able to see it unless I highlight it. If I highlight it, you can see it. You can't see it? Now you can see it. You can't see it? Now you can see it. Because what the mid band is, guys, it's really simple to understand. All it is the 20 period moving average. The 20 period simple moving average is the mid band, nothing else. And the 20 period simple moving average from the dawn of moving averages on every time frame has acted as a support and resistance zone. And that's pretty much how you use the mid band, is using it as an identification on pullbacks in trending environments. And so bullish uptrend pulls back to the midpoint. That's a 50% basically Fibonacci retracement, not all the time, but that's a 50% Fibonacci retracement. That's a pullback. That's a standardized pullback. And so that mid band is kind of just that 20 SMA. Now, the upper band and the lower band, when you are looking at it from an indicator perspective, the upper band and the lower band is in 20 SMA. So you have a 20 SMA, you have a 20 SMA, you have a 20 SMA. It is standardized. The difference on the upper and the lower band is it's plus 2 standard deviations of price or minus 2 standard deviations of price. And so upper band, lower band, these settings are universal, guys. You're not really going to aggressively change these settings on when it comes to Bollinger Bands. Now, like all indicators, Bollinger Bands also works on every single time frame. but those time frames are going to be a little bit different depending on the style of trading you are. For the most part, if you're looking, for example, day trades, aggressive scalping type things, which is the vast majority of what everybody does here, you're obviously going to use it on your lower time frames. 1 minute charts, 2, 3, 5, 10, 15-minute charts, intraday analysis for those day traders, obviously. I like using it on the day chart for swing trades. Weekly charts, I really don't use it a lot, but I will use it every now and then just to kind of help me understand, are we breaking out of some squeezes on weekly charts? Is that going to lead to some is that going to lead to some momentum on the daily chart, so on and so forth. But for the most part, our conversation here today is going to be on the intraday side of the equation, as well as a little bit on the daily side. Now, shorter time frames, more noise, more mishits, more triggers. Longer time frames, a little bit more consistent, a little bit more reliable, and I think that's pretty standard when it comes to all forms of technical analysis. Now, I want to kind of talk about the first thing that we kind of have to understand when it comes to how Bollinger Bands work. When you think about Bollinger Bands, guys, they kind of work based on volatility. And so what you're looking at on the upper and the lower band as it expands and as it contracts. So do you see here, for example, let me get my Epic pen so we can do some drawing while we do this. And don't hesitate to ask questions either, ladies and gentlemen, as we do have these conversations. But do you see here, right here, how the bands are kind of contracting here and then they start to expand? What you're seeing there is the market is now breaking out. What you're actually seeing on this chart, guys, is basically the NASDAQ 5-minute chart today. I took this screenshot. Oh, you guys would probably know the chart, actually. I took the screenshot about an hour ago, right before the close. And as you can see, when the market started pumping earlier today, the band started expanding. And once the price got on top of that mid band and started expanding outside of your upper band, you now have momentum. That might not say chase it, right? You're going to make your decisions based on price, but that does show you that now that you have that expansion, now that's showing you that we're going into a trending environment. Now, why that's important is because as long as you stay hugged up against the upper band, you just have constant momentum. You see it kind of right here, constant momentum on the top side. But as you can see, as you get through the band, it doesn't like that. Price doesn't like staying on top of the band, guys. And so a lot of times what will happen is you'll go through some consolidation before you break back up again. Now, as long as you live in this upper band, you are dealing with bullish situations and you are only looking at bullish trades. You are not looking to counter trend a momentum trend. You are asking to get punched in the face by Mike Tyson in 1987 if you want to do that. This is not a counter trending tool. This is do you have momentum? Are you overbought? Are you going to be looking at a little bit of a pullback? It's that type of tool. And so when you're looking at the tradable setup, just from a confirmation side of the equation, anytime you're in that upper band and you're in a trending environment, you have confirmation on momentum, guys. But a lot of times, if you start hugging that upper band, you get a little bit overextended on the price, as you can see right there, and you form that pullback. And where does it come into? Right on that 20-period moving average before it confirms and sees that larger move. And so you see that happen quite a bit across the board as you start to understand these overbought and these oversold zones. So once again, as you start expanding, you're starting to see increasing volatility. As you contract, you start to see decreasing volatility. And so as it goes up, you're looking bull, you're looking bull, you're looking bull, you're looking bull, you're looking bull. Even as it's coming back down here, you're thinking bullish. You really are. You're thinking bullish. You're looking for a pivot. You're looking for a pivot off that moving average, very similar to what we had down here as it got into the pivot and confirmed back up. It doesn't do that. It gets underneath that Bollinger Band. And once it gets underneath that Bollinger Band, I want you to think about it like, I'm trying to think of when we had this conversation, but it was a couple weeks ago, and I was talking about the depth of the retracement. And as it comes down, as it comes down, as it comes down, at some point it's no longer a retracement, correct? At some point. So for example, if the stock comes down or the market and pivots back up, nice bullish retracement. Comes down a little bit further, pivots back up, good bullish retracement. Comes down a little bit further, pivots back up, not a bullish retracement. At some point, it comes down too far for it just to be a pullback. And on when you're using Fibonacci's, that level is going to be probably the 61% level. Some people use maybe the 50% level. Some people use the 75. But at some point, it goes too far down and it screams weakness is what it does. And so on Bollinger Bands, we're not using Fibonacci's or that, but on Bollinger Bands, the technique is if it gets underneath that midpoint, which is the standardized 20 SMA, you've given up enough of the momentum that you're now looking at something else in the market. And that something else can be a consolidation, short-term reversal on the 1-minute chart, for example. It can be a consolidation breakdown, quite frankly. But in that moment in time, when it gets underneath this 50 right there, you're not looking to be aggressive, guys. You're looking to be aggressive above the midpoint. You are not looking to be aggressive on the bull side underneath the midpoint. You get a little bit cautious. And then what occurs after you get underneath the midpoint, you typically know you're going to go through what's called a squeeze. I want everybody to write that word down. Squeeze. Like a short squeeze. Everybody write that down. Squeeze. It's one of those words you got to think about a little bit. Squeeze. There you go, Blas. Everybody write that word down. Squeeze. I want you to write it down. Lock it in, guys. You write something down, you lock it in, you remember a little bit more. When you hear something, that's one thing. When you write something down, that's another thing. When you actually do something, that's another thing. And if you want to truly learn this and lock it in, you're going to take more action than just listening to me say it. And so in terms of that squeeze, that's when the bands start contracting with one another. They get tighter, showing you that you're forming up consolidation. And the tighter that bad boy squeezes, the better it's going to be. Now, as we get through this entire conversation on the Bollinger Bands from a definitional perspective and an understanding on how to use it, we're then going to go look at the major asset classes today to see if that could have helped us navigate the environment. And so once again, when you are navigating these overbought, oversold zones, realize anytime you're hugging the upper band, you are some degree of overbought. And when you do hover that upper band, either you're going to be momentum trading it, otherwise known as bar by bar, or two, you're going to be waiting on the pullback, and the pullback zone is the midpoint, i.e. the 20-period moving average on this midpoint. Once it gets underneath the midpoint, what do we do? Once it gets underneath the midpoint, what do we do? What do you guys think? What do we do if it gets underneath the midpoint? Bullish uptrend underneath the midpoint. What's that? What's that tell us? Don't go long. Not yet. Right? Not yet. Not yet. It tells you that that trend is over. That the momentum we saw early this session is over. In fact, it tells the exact opposite of what Blas just said. Right? Well, yes, it's going into that squeeze, Blas. Yes, absolutely. So if it gets underneath that midpoint, I saw you delete that full port long there. It made me laugh, by the way. But what it does is it tells us to tap on the brakes on the bull side. It tells us to be patient here. Allow development to occur, guys. What we all know is, as a trader, one of your biggest risks as a trader, in my estimation, is over trading. Can you guys agree with that, by the way? One of the biggest risks as a trader is over trading. RQ agrees. What about everybody else? Cindy? Yeah, I'm right there with you guys. Like, it's a big risk, over trading, not sticking to your system, not being patient, not allowing development to occur, pushing the edge like a degenerate gambler, pushing the edge like an alcohol. It's constantly pushing something. The best traders hunt. And what I mean by that, guys, is they know what they need to see, and they are patient, and they allow it to develop, and then they pound the table when they get their signal. And so when it gets underneath this 50 barrier, it's not a short signal. It's not that. It's the previous momentum in the trend is now over. And you should be patient and wait on the next pattern development. And when it does, it will break out and we'll start to see the expansion again. RQ says, can this be used for confluence with a correlating market like ES to find an edge, finding a divergence between the two? It's best used in conjunction with, like, for example, upper band with momentum. You want to match it with MACD expansion bars on the histogram, so on and so forth. It's not best used on any type of reversal or whatnot. So I would definitely say a correlating with the ES. Yes, I would say that. I don't see a lot of divergence on Bollinger Bands, and I wouldn't use it as a form of divergence. It doesn't pair great with other indicators, honestly. It's a little bit unique that way. For example, I don't like adding, when I'm looking at the bands, I don't like adding all the moving averages. I don't like looking in conjunction with RSI. It's really just utilized by itself, in my estimation. Other indicators can help you confirm those decisions. For example, if you're too far overextended, for example, RSI is so much better in just identifying pure overextension than Bollinger Bands are. Bollinger Bands are helpful to understand, do you have consistency of momentum, or is that momentum shifting? And consistency of, okay, are you too far overextended and waiting on the pullback? For example, the pullback on RSI versus the pullback on stochastics versus the pullback on Bollinger Bands. The pullback on Bollinger Bands is going to be a little bit cleaner, a little bit better if you're going to use this indicator instead of, say, an RSI stochastics. So on pullbacks, I prefer MACD. I prefer Bollinger Bands. On something like a breakout or a reversal, I prefer RSI and stochastics. And so it's going to be a little bit different, but I would have to know specifically what you mean by the confluence with others and the correlating status against the ES to find the edge between the two. I'd like to understand a little bit more what you're suggesting there, because I don't think I would disagree with where you're going with that, RQ. And so I just kind of answered it in general on the indicator side of the equation. But let's continue that conversation, because I do think where you're going is a wise way. I would just have to understand a little bit more of what you're specifically getting into there. Okay, so you're talking about between ES and NQ. All right. Okay. Yes. If NQ pumps, ES doesn't, could there be an indication of a lag move there? Maybe. But in terms of the forecasting of a big move, absolutely. Now, what I would suggest is in terms of the correlation of other asset classes is, I would say that is, do you see the dollar do that first? And if the dollar does something first, you could see a lag impact on gold, silver, ES, NQ. But I wouldn't suggest NQ versus ES. I would use a divergent product like the dollar against a very divergent byproduct like gold, for example. And so I would do that. Now, ES and Q, if they typically run on the same gasoline, you would see them as confirming against one another. And so I would say the dollar versus some of those other asset classes on the divergent side of the equation. No, and again, it's not necessarily whether or not you trade the dollar. And I want to be clear on that, because you don't have to trade the dollar to understand how the dollar impacts everything you do trade. And so the dollar is one of those asset classes that I anchor against quite a bit, even if I'm not specifically trading the dollar, because that helps me understand other asset classes. But we'll get back into that. Let me kind of get back into the presentation here, and then I'll open it up to Q&A here in just a moment or two. Now, what the Bollinger Bands do is they widen. That shows you increasing volatility. As they narrow, kind of coming into that squeeze, that shows you decreasing volatility and thus consolidation. And that's what getting underneath that 50 period in a bullish trend really suggests, is you're going to go through some consolidation in developing that next pattern, whether that next pattern becomes a breakout or whether that next pattern becomes a breakdown, we'll have to wait and see on the data, but that's what it does suggest. Now, in terms of the squeeze, and I talked about this a little bit just recently, but let's kind of dial in that squeeze. There was a really good squeeze happening on silver here today. What a squeeze is it's when the bands start getting narrower and narrower and narrower. How many of you are familiar with the symmetrical triangle pattern? Who here is familiar with the symmetrical triangle pattern? Basically, you have, resistance coming down, right? Support coming up, and basically the price here gets put a lot of pressure to where it breaks out pretty aggressively one way or the other. That's the hallmark of a triangle, is it's basically putting pressure on it, right? It's putting pressure on that resistance. It's putting pressure on that support, and then you typically get an explosive breakout one way or the other. That's a symmetrical triangle in the market. It's a technical pattern. Squeezes are similar to that. The price is getting compressed. It's coiling up against one another. And the further it gets tighter and tighter and tighter and tighter, it can't continue that, and price is going to explode out of that. And so as the bands get tighter, you start to anticipate a breakout starting to occur. And a lot of times you're going to want to see it get underneath that band, close underneath that band, and then see some continuation there. And so I want to come into silver really quickly just to kind of take a look at it from a technical perspective outside of just the screenshot here. But let's go, and I'm going to come back to the ES here in just a second. But let's go to the silver chart here, and let's come on that 5-minute chart. Okay, so basically, I don't know if you guys remember me saying this in Discord just a little bit ago, but I said silver's breaking out. Silver's breaking out right now. Well, what I was saying, guys, is silver was forming up a really good trade right here. And basically what you had done is you had all this wide range volatility earlier this morning on silver, right? Bands are everywhere. Bands are expanding, showing you momentum, showing you volatility, but it's not consistent. Up, down, everywhere, it's not consistent, just volatility. And so the bands are going to expand on that volatility, whether that volatility is consistent up, consistent down, or just choppy neutral. It's going to expand on that volatility. And what occurs is as those candle and the ranges of volatility tighten up, it gets tight, tighter, 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 tighter. Now, do you see right here where the band starts to expand here? Right here. Can you guys identify that as the band starts to expand? And the band starts to expand here. As the band starts to expand, you're starting to see momentum play out. You don't make your trading decision based on the band expanding. You make your trading decision based on the breakout. And so do you see this pivot right there? Broke out, confirmed, continuation. You got your trigger on the price. You got your bands expanding. Bollinger is basically suggesting we're now going to see a little bit of momentum. Now, as it goes up, 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 now what's it telling us? Now what's it telling us here? The bands are starting to contract. That early move is over, and I would be expecting a pullback back down to the 20-period moving average. And so when you look at those tight ranges and it coils up, It's not going to continue to do that. And as the market here on silver stayed above that 50 barrier, that midpoint to 20 SMA, and underneath that upper band, as it was squeezing and consolidating tighter, you see the price get real tight here. Bands are getting tighter as well. You can start anticipating a breakout there. And you would be anticipating a bullish breakout because the bands were consolidating on top, not the band, but the price was consolidating on top of that midpoint. If the bands were consolidating on the bottom of the midpoint, you'd be looking for a bear breakdown, and that was at the 3630 level. The bands consolidating on the top shifts the perspective, shifts the analysis, and you're looking for that to be a bullish breakout. So when you understand a squeeze, what the squeeze is basically the conclusion of the momentum changing in the marketplace. And as that squeeze gets tighter and tighter and tighter, it cannot continue to get that. And then you see an explosive move outside. And so a squeeze occurs when the bands start to narrow and narrow and narrow, signaling a low vol environment. Really good for buying options, basically, and getting involved there, and it signals a potential breakout. But let me be very clear. In the squeeze, in between the bands, does it suggest anything? In the bands, going through a squeeze, we're in the band, so we're inside band in a squeeze. Does it suggest you do anything? What do you guys think? Once again, you're in the bands, you're going through a squeeze. What does it tell me? What am I preparing for? There's no wrong answers, guys. It has to break. There's not an if and or be. It has to break, guys. No, Boba, you're not taking profit because you're not in a trade yet. You would have been out of that silver trade long before anything here. And then the volatility was so aggressive following the PPI report earlier today that you just wouldn't have done anything on silver, quite frankly. But you would be prepared for a breakout. Absolutely. You would be prepared for a breakout. My point is, you don't want to trade when it's consolidating in the squeeze. You want to put your trade on when it starts breaking out of the consolidation. It's no different than if we were looking at a 4-bar consolidation pattern. You do the trade when it breaks out of the consolidation. It's no different when you're looking at a neutral trend. You do the trade when it breaks out of neutrality. When you go through pattern development in general, you wait for the pattern to get broken for you to make the trade. And so it's not a whole lot of different from that, quite frankly, on the band side of the equation. So once again, when the bands contract, volatility is dropping and the market is coiling. Once again, volatility is dropping and the market is coiling. It's preparing to make its move. And so I know it's getting ready to make a move. I need to be ready when it does make that move, and when it breaks out of my technical condition is when you actually make the trade. So here on silver, when you were looking at it earlier today, you were looking at a potential breakdown, popped right back up above that 50. This chart's obviously a little bit old versus today, but once you popped back up above 50, you start thinking about it on the breakout side of the equation. So in consolidation, i.e. squeezes, if you're squeezing toward the lower end of the range, you're looking for a bear breakdown. If you squeeze above the range, i.e. the midpoint, 20-period midpoint, you're looking for a bullish breakout there. Now, questions, guys. Questions. I love questions. Neek, what deviation are you using? 2 standard deviations on the top side, 2 standard deviations on the downside. So the midpoint is 20 SMA, standardized. The upper band is 2 deviations. It's the 20 SMA plus 2 standard deviations is basically what it is. Okay. All right. Now, we've talked about that backbone, okay? The 20 SMA, that midpoint line, that blue line you all see on the chart, That 20 SMA is a battleground for bulls and bears in a trending environment. You see it, if you don't use Bollinger Bands, you'll see it on other things because a lot of technical analysis kind of leads to the same conclusion. RQ, Neat, Gabber might be using something slightly different than me, but all of a sudden we all get to the same proper conclusion, right? We're all kind of, that price action is all kind of leading us to that same proper conclusion. Indicators give us a different visual representation of that proper conclusion from a technical perspective. The 20 SMA is the battleground to me, as the bands expand. As bands expand to the top side, as bands expand to the downside, that's where the zone becomes chiefly important. As we're going through consolidation squeezes, I'm not as anchoring against the 20 SMA and the Bollinger Bands, not nearly as much. I'm really looking at it to get outside the ranges to show me some momentum. So in a trending environment, that's where this battle zone is, right? I don't think so. I don't think it's too much noise, honestly. It might feel like too much noise if you're looking at it on a 1 minute chart, because a 1 minute chart gives you a lot of noise. It's not going to give you as much noise on a 30-minute chart because the 30-minute chart doesn't give you as much noise. Same thing with a weekly chart. For example, a weekly chart, the 20-20-20 settings are, man, they're slow as tar, like slow as tar. And so I would say it's more of a time frame thing, right? The 1-5-15 is going to be quick. It's going to be quick. That's why scalpers like it. I like using it on a 30-minute chart. Like I like kind of getting those, smoothing out the lower ends. Like I'm not going to go to a 1 minute chart, add my Bollinger Band and say, all right, Bollinger, tell me what to do, right? I'm going to use these indicators to help me confirm kind of environments more than anything. Should I be looking for a pullback? Should I be looking for a breakout? I'm always going to make my decisions on the chart. Always, 100%. Bollinger Bands can help me understand what patterns I should be looking for, what type consolidation breakouts versus momentum pullbacks type scenarios. And so, yeah, I would definitely say it's as much of a time frame issue as it is the actual settings. But if you go like in terms of further on the standard deviations, you're going to loosen that up, right? You're going to loosen that up, and there's nothing wrong with that. What I would suggest, though, is always understand the context of the indicator, how the market sees it. And that's kind of how I look at indicators in general. I'm a little bit weird that way, a little bit analytical that way, whereas I don't feel like me customizing indicators helps me get an edge against the market. I feel like my edge against the market is my ability to read price action. Does that make sense, guys? Like that's what I feel is my superhero power. That's your superhero power. Our ability to read that price in the real time. I don't personally like adjusting too many settings on the indicators based on what the original authors of the indicators did. And the reason I don't do that is because I want to understand the general market mentality with indicators. I'm not using indicators to necessarily tell me to buy or sell. I'm looking at price to make those decisions. For example, you look at this on the NASDAQ earlier today, this little double top right there. If you break that double top, I could care less what any indicator says. Like any indicator says, you break a double top and that's a breakout. That's good. Let's get it up and go with the stop right underneath the breakout channel. And so I'm going to make those decisions based on price. And because of that, I want to see these indicators from the viewpoint of the market itself. Does that make sense, everybody? And again, I'm not saying you can't modify indicators. That is not what I'm suggesting. I'm just suggesting if you're going to do that, always go back to the original to understand market understandings as well. All right. So where do we use the 20 SMA then? For the most part, we use the 20 SMA as pullback zones in bullish uptrends and as pullback zones in bearish downtrends. And if it breaks those pullback zones, like we saw here, at that point you do have something officially different on the chart versus what we have been talking about. That pullback zone is a support and resistance zone. Think about that 20 SMA as a support zone. It's not like at BluSky, we use a lot of horizontal levels, bank levels, those types of horizontal levels. Dynamic support and resistance is moving support and resistance. It's not stagnant. It moves. That's why moving averages are utilized as dynamic support and resistance zones, because they have a tendency to move with the price. And so you have vertical support and resistance, you have horizontal. This is a concept of a vertical area of support and resistance. You could also look at trailing stop losses underneath that midpoint as well. If you ever have a difficult decision in where to adjust a stop loss, obviously moving averages can be one of those ways that we can make those decisions in adjusting stop losses and so on and so forth. So in that trending environment, guys, when you get the squeeze here, good squeeze on crude oil yesterday, by the way. Do you see this squeeze here? Now, when we get this candle here on that squeeze right there, what does that tell us? What we went through a squeeze, we broke through the squeeze. What does it tell us? I would suggest on the downside, I would say underneath the midpoint though, Boba. I don't think you would have to get the lower band. No, you're probably taking a little bit too much risk there. But I would say if you're trading that on the breakout, I would say get it underneath that 20 period. Yeah, absolutely. But once again, what does this tell us, guys? This candle right here, what does it tell us? Is that a tradable signal? We got a breakout. Absolutely. Momentum, breakout. You broke through your range. You got the bands expanding. Now you got a bullish uptrend. And as long as it stays hovering on this bullish uptrend here, guys, that is nothing but momentum. That is all that is. Momentum, 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 momentum. And if you're waiting on a pullback, you missed out on all of that run. And that's fine. I'm not saying you made a mistake. I'm just saying if you were waiting on a pullback, you waited on a heck of a long time before it did eventually pull back. Remember, the breakout is momentum. And so you're looking initially on that momentum side of the equation, looking for it to get above the next day's high, or not the next day, but the next candle high. And then you're giddy up and go, trailing that stop loss, lag it against that 20 period, or lag it a little bit tighter against that 90 MA on your chart. But you're going to lag that stop loss on that break. Now, it breaks, it drives up, 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 up. Again, there's nothing wrong with saying right here, I want to pull back. There's nothing wrong here saying I want to pull back. But if you're tracking it, you also got to be ready for breakouts too. Short form consolidation breakout, short form consolidation breakout, short form consolidation breakout. Eventually, you get your pullback and it starts to contract. And so as we deal with those momentum type trends, ladies and gentlemen, it's again, you're always going to make decisions on that chart, but if it is going to hug that upper band, and I mean hug it, I don't mean like 4 bars of consolidation, I mean hug it. That is constant momentum. And the tradable signals there are pure momentum based, meaning bar by bar. And what bar by bar is you just play the bar. And so here, for example, you just put the order in above the high, underneath the low. Play the bar, above the high, underneath the low. Play the bar, above the high, underneath the low. Play the bar, above the high, underneath the low. As long as it's hugging that 20 period moving average, that's really your tradable setup there. It's the only thing you really can do, because you are extended in a momentum condition. You would have to bar by bar trade that, or wait on the eventual pullback. And that's what I always say, guys. If you miss the breakout and you don't get a clean trigger on the breakout, I don't recommend chasing very often. This was a unique, I just wanted to pull up an example, but this is a unique example of a strong bullish move in a trending environment. A little bit abnormal. Just wanted to show you an example of that and kind of how to handle it if you do see that on the Bollinger. If it breaks out of a squeeze and hugs that upper band the whole way up, that's pure momentum, and you have to bar by bar trade that, because no other stop loss. You put a stop loss underneath the 50 period on this bar, that's a lot of risk if you're wrong. You put a stop loss underneath that 20 SMA. I keep saying 50, guys, because my blue standardized line is a 50 line. On Bollinger Bands, the 20 is the blue line. I need to adjust that. But do you see how it's like down here when you break out of the squeeze, you can put a stop loss underneath that 20 period. You break out of that momentum here, there's just too much vertical distance from a risk perspective, and so you got to be bar by bar trading. Second, if you don't do the bar by bar trading, at that point, what you do is you look for trading the actual pullback itself. Now, let's take a look at some of these major asset classes here today. And I want to take a look at the ES here, guys. Kind of take a look at what we could be in store with a little bit here tonight. Now, market did officially break out there. It came right back down within the range. Let's take this on a 30-minute chart. Okay. Not RSP. Let's go to ES. Let's get on that 50-minute chart. Now, what does Bollinger, what does it suggest right now? Are we expanding or are we squeezing? Right now, the ES. We're squeezing. Okay. Now, that's not too abnormal, the squeeze. Okay, it's not too abnormal. Markets shut down. We're going to be, we're going to have a few hours before we get into the Asian markets. And so not a lot of information coming. It's not abnormal to see a squeeze here. Now, as we start getting into the overnight session here tonight, do we think we might see some movement based on the fact that we were squeezing coming into the close? I'd be a little bit surprised if we stay squeezing all the way to the European hours, okay? And so we're seeing a little bit of consolidation here, and it's getting a little bit tight. You got that 60-50 level that is acting as a resistance level, and you got kind of a cluster here, but I would go to the wicks here as at support at 60-37. And so you got a 13-point range of consolidation here on the S&P 500 as we kind of navigate tonight's session. Now, early, we had that big upward move in price. It hugged the upper band. What's the trading style as it hugs the upper band? What type of trading are we doing when it's hugging the upper band? Momentum style, bar by bar, aggressive, scalping, that type of trading, guys. And again, I don't want you to think about this as technically overextended. It's hugging that upper band, showing you momentum. You look to trade that momentum of the condition. Once you start consolidating here, once the bands start to contract, it's showing you the volatility is subsiding. So the volatility exploded on the PPI report, then it started consolidating after that. And now we're going through that squeeze. And so what we're looking for coming into later tonight is we're looking at this level right here at 51 now. You got two wicks right there, pretty even at the 51 level. You got this wick here and that wick there, very tight against one another at the 37 level. Should we have a strong opinion in the range here during the squeeze? Should I have a strong opinion here? Like I shouldn't have an opinion. You're in the middle of the range. It's a tight range. I shouldn't have an opinion in the range. I should have an opinion when it breaks the range and we start expanding again. Now, whether that's expansion on the top side, downside, that's going to be up to the market. For me, I would love to see this expand to the top side because everything we've talked about on that daily chart, having a little bit of open air, having the ability to scream a little bit, kind of work to those upper ends around that 62 level. And so basically what you're looking at here, once again, let's go down to that shorter time frame, is we're looking at a little bit of a squeeze. Okay, let's take a look at crude oil here. All right, crude oil here. Now, what did crude oil just do, ladies and gentlemen? It was shoring up a squeeze. You see that kind of starting to get squeezed a little bit. What's it now doing, guys? Just barely, just 15 minutes ago. What's going on here? What's crude oil starting to do? It's breaking. It's breaking to the top side. So if it's breaking to the top side and we're now starting to see the bands expand, right? We're seeing momentum come in, right? We're seeing that momentum come in. We're seeing those bands expand. And so one of two things can occur here. Number one, I can say, let me take the action right now, right? Let me take the action right now. Let me get an order above the high, stop loss underneath the low, and let's giddy up and let's go, 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 go time. Nothing wrong with that. You got momentum. You're hugging the upper band. Let's go bar by bar. Let's go momentum trade that. The second type of trader who's a little bit more hesitant, a little bit more cautious, doesn't want to chase it, they would say what? All right, we now have a bullish uptrend. Now I'm going to wait on that secondary pattern. The aggressive trader is going to say, nope, we're going to momentum trade this. We're going to bar by bar this bad boy, and we're going to take this momentum to where it ceases. The more conservative trader who maybe doesn't feel like they're comfortable hitting that first trigger, they'll say, no, we now have a trending environment. I'm going to wait on that first pullback, kind of what we saw in the NASDAQ, for example. Does that make sense, everybody? And secondarily, are you guys enjoying the show today? You enjoying MACD, not the MACD, but the Bollinger Band conversation? Is it helping, clearing up some things? Awesome, awesome. All right, let's take a look at, BluSky's YouTube, I would say, H. I know Makarim posts them, and I know the links are in Discord somewhere, but we record every one of them, and we do post them so that you guys can have access to them and so on and so forth. Absolutely, absolutely. All right, now, what's gold telling us? Going into tonight, what's gold telling us? Thank you for that, F. It's a beautiful hat by Mike. Okay, we're going through a squeeze. Good. Now, we're going through a squeeze. What should I be looking for? What we just saw in crude oil. Right? What we just saw in crude oil, what we just saw in silver earlier today. When we're going through those squeezes, guys, all it's suggesting is the momentum ceases, right? The momentum's not working for the bulls, not working for the bears. We're just consolidating in those ranges. And as we break through, that gives us the confirmation that we're now seeing the momentum side. And so going into tonight on gold, traders are going to be looking at two things. They're going to be looking at this 3410 level, and they're going to be looking at this lower level right here, kind of, and you can even draw that right there. They're going to be looking at that level right there. Okay, we're going through that tight consolidation here between 3410 and really kind of that 3398 level. And once again, if we're going through a squeeze and we're tight on the consolidation, should I personally have a strong opinion right now? This very second? No, of course not. Why would you have a strong opinion when nobody else in the world is having a strong opinion right now? I want you to think about that. Nobody else in the world right now is having a strong opinion on gold. Nobody else this very second is saying you got to buy gold right now. Nobody else in the world is saying you got to sell gold right now. Nobody is saying that. We can see that because of the consolidation. Okay, now as that consolidation gets tighter, they could say it later tonight, RQ. They could say it in 3 hours from now. They could say it in an hour from now. Crude oil just said it 30 minutes ago, right? Silver said it an hour and a half ago. And so these intraday timeframes, like we're only looking at a 15-minute chart here. Yeah, it could wake up very quickly. That's what it says to me, though. It tells me that I shouldn't have an opinion right now. I'm not going to do anything about it right now because it's just consolidating. We're going through a squeeze. But if I'm going to trade gold tonight, it also tells me I got two levels that are very interesting to track. Does that make sense, everybody? Well, and that's what happens a lot, guys. In fact, why don't you do me a favor? I want everybody to do this. Over the next week, I want you to go back and look at some of your trades that you made And I just want you to answer one question. Were you in an expansion moment, or were you in a squeeze moment? And just look at the Bollinger Band. Okay, take off every other indicator, take off your moving averages, take off your lines, take off everything, and learn how to make decisions without lines. Does that make sense, everybody? Like, lines are really amazing, but they shouldn't tell you where to do something. You got to be able to read that price action. And were you trading in consolidation time periods and getting whipsawed constantly? Or were you trading in true momentum conditions? And so what the Bollinger Band can do is they can just help you confirm all of that, right? Sometimes when we just look at these candlesticks, we get so fixated in one or two candles, we don't understand the entire context of the volatility around us. And what the Bollinger Bands can do is help us understand that. Yeah, we had volatility earlier today, but do we have it right now? No. What does that suggest going into the later sessions? It suggests we're going through a squeeze, and we certainly could see a breakout one way or the other of the price action. And so when you're looking at, crude oil, for example, again, squeeze, tight squeeze, breakout, probably doesn't stop until we get up to 69. And then above 69, it probably doesn't stop until we get to 70. And then 70 probably doesn't stop until 71. So once again, coming into that 30-minute chart, more like the 15-minute chart. We were living on the 15-minute chart there. Let's take a random instrument. Somebody give me some instrument. Don't care. Give me a stock. Somebody give me a stock. Don't care what the stock is. You guys tell me one of your favorite stocks. Tesla. All right. Now, the Bollinger Band right here was contracting, squeeze, broke through the squeeze. That's a short signal right here. That's a short signal. Now, this is on the overnight action, obviously, but that is a short signal. Just momentum to the downside. Okay. Little tiny squeeze here. Cash open big. Lots of chop here. Lots of chop. Lots of chop. I don't see a signal here. I really don't. Maybe right here. This candle, pretty good signal, quite frankly. You're breaking back up above that 328 level. That's a pretty good signal, quite frankly. Kind of like that one. Got stuffed out and got smoked out and all that jazz, but in the moment, that's a pretty good little signal. Once you get underneath the 50 here, once you get underneath the 50, this little movement, you're no longer bullish. Once you get underneath the 50 here, that you should not have been looking at this in any other lens besides some degree of neutrality. And then it squeezes a little bit, a lot of volatility here. This is not a tight squeeze. It didn't consolidate long enough, quite frankly. But once it got, did I say 50 again, Gabber? I'm telling you, the 50 is like it's constantly blue. So it's been blue for me for 20 years, mind you. It's the 20 period moving average. Thank you very much. Thank you very much. But once you get underneath the 20 SMA here, you shouldn't be looking on the bull side. You know you got to redevelop. You got to develop in a better situation. Now, as it's coming down, what's it telling us? We're seeing a little bit of expansion here. We're seeing a little bit of expansion. Starting to consolidate. Should I be looking on the bull side on Tesla right now? What do you think? Should I be looking at a bull trade on Tesla right now? The answer is no. The answer is no. You're expanding your bands to the downside. You have broken through that that midpoint 20, and now you're basically consolidating in a potential low base right at a key support level. I would say the indicator is basically, as of right now, again, things change, obviously, but as of right now, I would say the indicator is suggesting the next pattern will be a bearish pattern, is what I would suggest. Not a good look for Tesla, but that not a good look has nothing to do with this and everything to do with once it got underneath that 20, not only did you get underneath that 20, but you got underneath that pivot point too. So this was kind of that nasty candle today right there, right there for Tesla. Don't get me wrong, this one's a terrible candle. This is a terrible rejection candle. But that candle, once you crossed underneath that, man, it tried to hold that 20 right there. Confirm back up, looks good, can't do it, gets underneath that. That's just a nasty, nasty look. Well, guys, what I wanted to do today with our conversation on Bollinger Bands is obviously do two things. Number one, constantly expand our knowledge on technical analysis. That's probably my number one goal when it comes to this lab every week, is expand our knowledge on technical analysis. Constantly work on new things, constantly update, constantly refresh, constantly improve our ability to read charts, whether that's price action, trends, patterns, support, resistance indicators. Obviously, we've had a lot of conversations about that. As we move on into next week, guys, we're going to be talking about options. And I know we're a bunch of futures traders, but guys, they have options on futures too. Okay? They have options on futures as well. They have options on stock, and we're going to be getting into 0DTE as well. So we're going to be talking about options next week. And do not ever hesitate, guys. If you have a question, hit me up in Discord. Add me as a friend, hit me up in Discord. Outside of that, I'll see you guys on Monday.